Okay folks, essentials to market structure. And this module is going to be really based upon the premise of looking towards helping you educate yourself in determining trade direction. This is probably one of the most reoccurring email inquiries and posts that you see in the forums directed to me. It's my goal obviously to share further amplification on some of the concepts that I use in determining trade direction, and hopefully this will be insightful for you. But what do we do when we sit down in front of the charts? What's the primary function as a trader? Well, you as a Forex trader, you want to be finding your way through price. And as a new trader, I can understand how daunting this task may be because there's so many different time frames you have. Your monthly, weekly, daily, 4 hour, 1 hour, 15-minute chart, 5-minute chart, 1-minute chart. You have tick charts. All these different time frames. It's very bewildering sometimes if you don't understand really what it is that you need to be doing and breaking down price in a uniform, structured way. So the first thing I'm going to really counsel you on is your primary objective is to know your time frame that you're trading. Okay, and it gets back to what type of trader are you going to be? Are you going to be a position trader? Are you going to be a swing trader, a short-term trader? Or are you going to be a day trader or a scalper? I can't teach you how to find the correct style of trader. That's within you. That's all part of your personal makeup. So this module, much in the same capacity my other modules have been, they're going to speak in general terms, okay, but it's going to give you enough insight for you to be able to determine what it is that you need to be focusing on for you to find the most optimal way of trading for you yourself, okay, because each of us are going to be different. As you grow and you mature as a trader, you may be multi-time frame based in terms of trading. In other words, I consider myself a dynamic trader simply because I can trade any one of these time frames. Now, I excel in the short-term to swing trading area, but I can day trade and I can scalp, but I prefer not to. It would be my advice to you is, if you can, try to work within the short-term to day trading in the beginning, because it's going to give you the most immediate feedback and it's going to give you the confidence you need to be sticking to a plan, because obviously as a position trader you don't have a whole lot of opportunities materializing that frequently. Swing trading, again, same capacity. It's going to be a little while between each setup, so it's going to be harder for a new trader looking to find themselves to wait between the signals and stick within that specific framework for trading. So short-term trading and day trading and scalping, let's just avoid that for now, but we will talk about how you can utilize these concepts for scalping. But again, short-term and day trades, if you are brand new to price action, those are very rewarding because they give you the immediate feedback new traders sometimes need. So let's talk about what the professional perspective is when we're applying market structure. Well, obviously for position trades, this is going to be anywhere between 3 to as much as 6 months to a year in terms of duration. Now, I don't have a whole lot of types of trades like this, but every 3 to 4 months in the marketplace, whether it be in stocks or commodities or Forex, there is a specific swing that manifests itself, and we talked about that in other videos and other teaching. I'm not going to cover that here, but if you are that type of trader, obviously the 3 time frames that you would utilize to break down market structure for your particular market would obviously be monthly, the weekly, and the daily. Okay, monthly being your highest time frame, your weekly being your midline or mid-level time frame, and then you have your daily. That would be your short term. Now, as a swing trader, okay, your premise for breaking down market structure will be comprised of looking at the daily, the 4-hour, and the 1-hour chart. Okay, your setup will be based upon what you see on the higher time frame, the daily. Much in the same capacity for a position trade, the monthly will be your position trade premise. In other words, if we are considerably overbought, there should be some kind of a topping formation on a monthly chart, you would look to see market structure break down on the weekly and daily to facilitate a short position. Well, on a swing trade model, you would utilize that same measure of market structure by utilizing the highest time frame for swing trades. In this approach would be the daily chart, and then breaking that down into 4-hour chart, and then lesser price action study in the 1-hour chart. So you'll be timing on the 1-hour, you would be managing on the 4-hour, and the premise or the trade idea would be built upon the highest time frame, which would be the daily chart. Okay, in the swing traders model here. If you're a short-term trader, obviously the duration of time for these types of trades could be anywhere between 1 day to as much as a week or so. Swing trading is about a week or more in terms of trade duration, and I forgot to mention that. But for short-term trades, you'll be using the 4-hour chart for your trade premise or your directional bias. And then on the 1-hour chart, that would be your trade management or mid-level time frame. And then your 15-minute chart would be utilized for your timing for entry and possibly looking for early reversal signs that your trade may be petering out and it's time to take profits. For day trades, obviously, you can see it's the 1-hour chart. It'd be your highest time frame. You would be managing your trade on the 15-minute time frame, and your 5-minute chart would be utilized to enter. Now, it's not to say that you can't use a 5-minute chart on the short-term swing and position trades for entry. Okay, I'm giving you the framework for at least having 3 time frames across the spectrum of your trading, and how you break down market structure over these 3 specific time frames for each individual trading model will give you, again, the building blocks to flesh out what you need to see in terms of directional bias. Okay, so let's take a look at closer look at price action and market structure. Now, the keys to multiple time frame market structure, okay, are rather simple. Where's your focus? Your focus should be on the highest of the 3 time frames. Trades will be managed by the highest or mid time frames. Okay, in other words, if you are a swing trader, you're going to be utilizing that daily time frame to manage, or the 4-hour chart to manage your trade. Okay, but the daily is going to be utilized to facilitate the trade premise. In other words, that's going to give you your directional bias. Okay, the market structure that is on the daily chart, that's framing your swing trades. Okay, once you get into a trade, you would be managing that trade on a 4-hour time frame, and you would just use the respective time frames we just talked about in the previous slide. And then your 1-hour chart would be used for timing purposes. Okay, so the shortest time frame in that regard for swing trading would be the 60-minute chart. So your entry signals would be derived from having studied the market structure on the daily and the 4-hour. Then your 1-hour chart would facilitate the specific entry point. Okay, so in other words, you would do your entry concepts and techniques on the 1-hour chart for swing trades. The highest probability trades are made in the higher time frame direction. Okay, now there are going to be instances where the higher time frame premise may be bullish, but you're approaching a key resistance level, so that may be trumped. So that's where we're going to go back to the core essentials to technical analysis, that being support and resistance trumps everything. Okay, without the understanding of key support and resistance levels, you're not going to get to a directional bias regardless of what trading model you're using, position, day trading, whatever it is. If it's not framed on the premise of key support and resistance levels, it's probably going to be a struggling point for you as well. Okay, so you have to go back to the core essentials, to my concepts, and just sound trading altogether. Key support and resistance levels are where it's all at. Okay, without those, all of these lines and all of these procedures that we're going to be covering here, and what we've covered in previous videos and such, is going to do no good to you. Okay, so you have to understand what is a key support and resistance level. So if you are looking at the highest time frame for your particular model, that will hopefully draw your attention to whatever key support and resistance level at that point in price action. Obviously, you can always go out to a daily and weekly just as a a catch-all as far as whatever time frame you're trading. If you just look at a daily and weekly in terms of support and resistance, those will be helpful to you. Now, the market profiles will also assist you in market structure analysis concepts, that being, are we in a trending market? Are we in a reversal pattern or formation, or that type of profile in the marketplace? And are we in a consolidation preparing for a breakout scenario? Okay, so market profiling is essential to helping you and assisting you in measuring what the current market structure is. Okay, now, are we bullish or bearish? All right, when we're looking at market structure, or we're referring to market structure, what are we speaking about? What is that we're trying to get at? Okay, well, if you look at a price rally up and then price hitting a major resistance level, we're going to assume for a moment that this is your higher time frame. Okay, and I'm going to keep it generic because that way you can apply it to whatever your higher time frame is based on the model of trade that you are aiming to be. As price rallies up into what we would perceive as a higher level key resistance level, price never moves in a straight line. Okay, so there's going to be a consolidation, a price move up, another consolidation, a price move up, and then as price makes it into this resistance level, then we would be anticipating a reversal. So when markets start to break down, taking out short-term swing lows in here, this short-term swing low, when the highest time frame for your particular trading model, once that breaks, this would be the catalyst for you to say, okay, this is probably going to be an optimal trade entry based on the higher time frame chart of your profile. Okay, so for an example, let's just say that this is a monthly chart and you're looking for a position trade. Okay, if the monthly hits a key resistance level like this and it comes down and takes out a short-term low in the monthly, we know now that market structure has broken. Okay, so we have a market structure shift right here. Okay, now we don't know what price is doing over here. This is all in the future. We're anticipating these types of events in terms of price action, but until it actually gets there and starts trading, we can't deal with that yet. So it's all in anticipation and our anticipatory model as far as our framework and thinking about price action. This is what we would expect to see once this structure has been broken. Okay, but as price starts to rally up, we don't anticipate seeing a break through this resistance level. Okay, if we arrive at this as a possible resistance level, we would expect a retracement for an optimal trade entry, but then we would zoom in this area right here, okay, on a weekly time frame to hone in on more key shorter term time frame price levels. And then by zooming in, okay, we would possibly see a shorter term optimal trade entry or respective sell pattern to convince us even further that this is probably going to be a selling scenario. And if we move down into a daily and see something even similar to that, okay, you would have all these nesting confluences of implied resistance levels. Once a higher time frame market structure is broken down, then we would be able to position ourselves in sync with a top-down approach with market structure. Okay, and then as price starts to trade down, this is the gray area. All these areas where there's missing gaps, okay, that's intentional. Okay, we don't know what's going to take place between the time where we see an entry point and where we expect to see price get to in terms of our targets, and we'll talk more about that later on. But this is the gray area where you have to be comfortable with, okay, because you don't know what's going to happen from where your entry point and your expected exit point. Okay, you don't know if it's going to go down there. Okay, you don't know if it's going to reverse and take you out of the trade. Okay, but the overall framework, okay, or price structure, okay, this is how market structure is built. Okay, this is a price rally and a decline. Okay, we have consolidation. If we expect to see some kind of a rally in here, something's bullish that we would expect to support at, as price starts to rally up, okay, we could be utilizing our mid-level or shorter-term level time frames to see bullishness. Okay, we want to see support being held, resistance being broken. Okay, and every time price starts to pull back and retrace in here, the market structure concept that you would be utilizing would be to simply look for optimal trade entries. Okay, for buys, you would be looking for reflections to buy. You would be looking for type 2 trend following bullish scenarios. So in other words, in all of this area here, you'd be looking for price finding support and resistance being broken. Okay, it's that simple. That's the whole framework behind market structure. And as price rallies up into another shorter term or intermediate term resistance level in here, price will hopefully find some support. Okay, but if it does start to break down, be comfortable with price coming back and blowing out previous lows in here. Okay, there may be an important low that's taken place, and trailing stop loss orders would be trailed up below that particular point. Okay, so as price dips back down, all that's going to do is give you another opportunity to get long. Okay, now again, let's think for a moment. This is the higher time frame premise. Okay, this is the highest time frame chart. When we start seeing this consolidation in here and we see the higher level resistance level, because these are all known in advance, this is why we have support and resistance studies done. This is all part of our top-down analysis, seeing where price may be reaching for. So if we start seeing price rally up in here and then consolidate again, and this is another higher level key resistance level, if price continues to maintain support and breaks above all of these short-term highs in here, the market structure implies that we could possibly see a leg from this low, or whatever low would form back here, to this high, duplicated on the retracement here from this low to this high. The same thing could be said with market declines and reversals going long. Every time we see a consolidations, you want to study these for shorter term, more dynamic support and resistance levels. These areas are more easily tradable because they have discernible price levels. They're very clear. We don't know how it's going to take price from these consolidations to the next consolidation. We don't know that. We anticipate that gray area that's missing, these little pieces of market structure that's missing. I left that out because I want you to think like this. Okay, if it's a little confusing now, I understand, but if you apply this same general, I don't want to say profile, but this diagram, okay, in other words, in terms of how I have price lows illustrated here, if you look at how price declines actually materialize, you'll start to see these lows form like this, and inside of those consolidations and every swing low that forms, there's going to be a discernible optimal trade entries or reflection patterns, or generally fractal patterns. Okay, so you would apply these concepts, okay, with all the other concepts we've previously discussed, but looking at obviously a higher level key support level down here as a catalyst. Okay, so as price moves from a consolidation down into a new consolidation, much in the same capacity we just saw with the bullish move reaching up into a higher level resistance level, we could be seeing a consolidation in here with this higher level support level down here. This would be where price may be reaching for. So if it's consolidating here, we could look for a move from whatever high forms here to this low, okay, duplicated from this high or whatever high forms in this area down to this low. Okay, so while this diagram is fragmented, okay, think of in terms of the market maker profiles that I just recently shared with you guys this year. You see that same premise here as well. I don't need to draw the lines in here. You can actually probably remember by the way the profile was given to you. You can actually see it in here. Okay, so as price is engineered to go lower down into a support level, ultimately to trade higher, this is the building blocks that we work with. Okay, now because we have to live in the gray area and not expect a simple black and white premise to trading. When we see a consolidation here and price move down to a new area of consolidation and price moves down to a new area of consolidation, and then we have short-term breaks on market structure. Okay, in other words, we have a shift in market structure right here. As price trades down to that support level, again, this is all assuming this is the highest level of your 3 time frames that you're trading with for your particular trading model. When you see this shift in market structure here, we would anticipate seeing a bullish move higher. But here's where we enter a new level of gray. When we move into this new consolidation in here, this may not always translate into even higher prices going up like we have here implied. It could be just reaching up to go back to this range from this old high to this low. Remember, inside the range concepts. Okay, so you have to have that in mind. So that's why if you're going to be getting long down here, you expect to see some time of profit taking here, right? And you would be able to see that utilizing your mid-level chart, okay, for your swing projections. Okay, and we'll talk about that more as we go on. But generally, as you see price come down in here, every time price retraces and gives you new optimal trade entries, that's what you're looking for. You want to see price holding support, breaking resistance, okay, on this side of the support level being found. But as we're trading down into that support level, we're anticipating market structure to break lows and then find resistance. Break lows, find resistance. Break lows, find resistance. Okay, so every new consolidation, if we're expecting price reaching down to our higher level support level, okay, on our highest level chart, that's why we do our analysis on the highest level, because you want to see where price is probably reaching for. And by seeing where the highest level chart in our particular trading model is reaching for, again, we don't know for certain that they're always going to get there. But if you look in these higher level charts, it's going to give you the highest probability in terms of success. If price doesn't get to these particular points and we start seeing early market shifts in market structure, this could be a catalyst for, another type of trade. Okay, we could possibly get a long in here and maybe even reach up into the range from the high to this low here. That may be a means of profitability. It could be a good reward to risk scenario here. Okay, 3-to-1 could still exist within that framework of price action. Okay, but again, even if that happens, we could still take some short-term trades in here. But that may be a very, very short-term bias, only taking you up to a higher level bias to get lower support levels here taken out. Okay, in other words, you're going to have to blend some concepts here. The inside the range concepts, it's simply looking at lower lows and lower highs. Okay, if we do get a short-term bounce in here between the high that's formed here and the low here, this could be creating another optimal trade entry to get that fulfillment of this lower level support level down here. Now, again, we've seen this diagram before. Assuming that we have a high up in here reaching into resistance, as price breaks this short-term low here, the market structure is broken. So as price starts to retrace, every time it retraces, we're looking for new selling opportunities. But if we see a previous swing, as we see here, see this price swing here? Okay? If this level's taken out here, if we get a retracement or another additional sell signal, this is where we use swing projections just on price. We're not using Fibonacci. You can, but just looking at simple price action alone, this low to high, once it's broken, you can start taking this same measurable swing from this point here down to that same level and project it lower. Okay, and you get somewhere in this area here. Now, I purposely allowed the diagram to be a little bit farther because I teach to exit on the trade before the actual objective is met. Okay, so every time we see a broken swing, okay, this is a swing that's broken here. In other words, this low here, or whatever low it would have formed in here, I'm assuming that you can see this as a swing. when it's broken right here, we went below here, if we retrace back into it, okay, I've also purposely drew this a little bit past what would be expected as resistance. I've purposely allowed this to move beyond this low here to illustrate how support and resistance can be gray as well. It's not black and white. You're going to have to allow some flexibility with price. So when it starts to pull back deeper, okay, this still could set up the optimal trade entry. Okay, and while this isn't the exact level price was able to stave off a rally, it still was working within the previous range here and this high here as well. So we're still within a bearish market structure. So don't be lulled into thinking this is going to be a long to go higher, assuming again this is a higher level resistance level. And again, every little short-term retracement in here could be a catalyst for an additional entry using our smallest of the 3 time frames. Again, this is all modeling off of the highest time frame, okay, and then assuming once we get this broken down, this swing low here broken, we could utilize the mid-level chart for additional entries and or managing of a position that's already been assumed based on the highest of the 3 time frames. Now, as price also breaks down these swings, in other words, this swing up, once it's broken, okay, this is an engineered swing, okay, you see this in price action all the time, okay, it's a measured move, it's very simple, taking this low to this high, whatever that range is, subtract it from that same point here and project it lower, okay, that's the measured swing. Here is a measured leg move. You have the high down to a low here, and when price starts retracing here, we could see this as an intermediate term price swing, okay, or price leg. So we have a measurable swing here that we can use for projections. Then we also have a measurable leg, okay, so we have the first leg of price down here, and we retrace back utilizing the framework that's based on this swing up, okay, so we're blending 2 concepts here, a swing that's broken, okay, and within a bearish market structure. Then we also have a retracement back into a previous support broken. It should act as resistance, okay, and notice how this low here, I try to more or less imply that price could be reaching for even a shorter term support that's broken now as resistance. So what might look real clear and discernible on the charts, it may not be as clear cut as that, but we would expect this to be an intermediate term retracement for a new leg down, and that's when you would expect to see the high to low here on this leg repeated and projected from this high, whatever forms here, down here, and that would look similar to what we'd expect when you see intermediate term highs and lows. Intermediate term high is obviously a high that has lower highs on either side of it, okay, and an intermediate term low is a low that has 2 higher lows on either side of it. So it's very easy to see. It's simply looking at your candles and your bars on your respective time frames, and when you see these, note them, okay, and by noting them you'll have whatever ways you want to have it. I'm delineating and denoting that with these blue circles here. It could be anything on your charts. You could have stars, you could just type intermediate term high, whatever. You could put the little arrows on it, whatever it is that you use to identify them. That's your way of doing it, but it's important you understand where they're at. And when they start to nest out like this, okay, you can classify intermediate term to now long term, because if we have lower highs on either side of it, okay, this would classify this as a long-term high. That would also allow you to expect to see much longer term price swings, okay. So by nesting out and marking off your swing highs and swing lows on your respective time frames, you start to build a framework that's needed to be able to discern if you're in an intermediate term or short-term price swing within your market structure. Now that leg that we were talking about earlier can be seen here by having that intermediate term high noted. So this is a intermediate term price leg, and then here's your intermediate term retracement. okay? And then you would see, obviously, the next leg down would be replicated. So you can see the range between this low to high is exactly what you see here, causing you to expect or anticipate price movement back here. If you're in the trade still, once you're retraced, you can expect to hold on to that trade to get back down to these levels here, which would obviously, hopefully, be a higher level support level to also converge and have a confluence of reasons to expect to take some profits there. Now, by having all these things in the forefront of your mind and having specific price legs and price swings and how they nest together, it's important you understand that the framework of your market structure is derived from the highest level of the 3 time frames you're trading with. That's where the framework or the basis of your trade is built upon. Your mid-level chart is used to zero down into a smaller time frame, expecting to find support and resistance levels that may not be discernible in your highest time frame. Then your lowest time frame is used for your entry, and we're going to be talking about that specifically here. Assuming that we've built the premise of market structure and assuming that it's bullish, okay, everything we're talking about here would be obviously reversed for selling scenarios. But assuming we have a bullish market structure, okay, we're a swing trader. Let's say for a moment that our highest time frame suggest that we have a bullish market structure underway. We've traded off of a higher level support level, and price has given us a broken market structure to the upside. Okay, so there's been a market structure shift. Short-term highs have been broken on our highest level time frame chart. Our mid-level time frame has allowed us to zero in and find a key support and resistance level. Now we have this higher level key support and resistance level that's also converging with our mid-level support and resistance level. Okay, and that same support and resistance level may be a confluence of maybe a pivot, a trinity level. Okay, it could be a pattern that overlaps with that specific that level. Okay, and we now have a bias. Okay, this bias is bullish. It does not mean every single day you're going to get a trade that's going to materialize as a bullish move and see profitability. If it was just that simple, guys, everybody would be multimillionaires and we'd all be Warren Buffett's and super rich. So obviously, it's not that easy. You have to have some discernment and allow for some failure, because it's going to happen. But assuming that we have that premise, okay, our bias is to buy. It doesn't mean that traders can't make money going short this specific day or time frame. Okay, it just means that you are going to stick to being a bull at this particular day or particular time frame. Okay, so with that in mind, we always go back to our key premise of trading within kill zones. Okay, so you want to be doing your entries in your kill zone times: London open, New York open, London close, or Asia. Okay, but assuming we have already arrived at our time of day when we're going to be trading, okay, we already understand that the kill zone, when it's going to begin, we already have our key support and resistance level already identified, and we know where price should get to before we do anything, and that's going to be basically this little area right here. So when we're going to be seeing price hopefully at some point move down to that level here, this is our action point. This is where we take action. We do the entry here, and it could be on a limit basis or it could be a market order, but we're utilizing time and price theory. Okay, so this is what it looks like in your mind. There's nothing happening yet. You anticipate these events unfolding within a specific time of day with a specific bias in mind. Okay, you want to see these things line up. And I think what happens is you guys send me emails, you talk about it on the internet, posting on Baby Pips forums. I don't know what the bias is for today. Here's the secret. Every day the bias is both directions. Every day the bias is both directions. Think about that. There's traders making money going long and short that day. But you have to decide on what it is that you're trading based on your time frame and your profile, Okay, as a trader, are you a short-term trader, swing trader, are you a position trader? And you're looking for the bias that you're holding to line up with price action. Okay, you can't force price action to do what you want it to do. You can only get yourself in sync with what price may be doing and allowing you a ride. Okay, so with that assumption, we're looking at price here with the bullish premise that we would be expecting to see higher prices if we get down to this support level. Okay, so we've established that the higher time frame of the 3 time frames we use for market structure study is now bullish. Okay, we assumed that we have a very respectable support level down here. Okay, so if price trades back down to that level within a kill zone, we're going to be taking action here to buy. Okay, and all we simply do at that point is you wait. You wait until the kill zone starts, and when price gets to that specific point, you use whatever entry technique or concept you're going to be utilizing for your trade entry. It could be optimal trade entry, it could be reflection, it could be a grail, it could be a stinger, it could be any one of the trading patterns that you're utilizing, but it's happening at a key support resistance level with the higher time frame of the 3 time frames you use for market structure, giving you your bias. So when you have that, this is your action plan. This is what you do. You don't do anything else. Okay, this could be a sell pattern here. Okay, for someone that's a very short-term trader. Okay, and trades down, and they've made money from this point here to here. That's not your trade. Okay, so don't try to force more out of the concept than it's intended. Okay, you're just simply looking for a bias for your style of trading. Okay, it doesn't mean that you're going to be right all the time. Okay, so take that out of the equation. All you're doing is looking to get yourself in sync with whatever price action is doing based on your premise or your style of trading. All right, obviously this is a very simple approach to dealing with directional bias, but it's meant to help you avoid the overcomplication that tends to happen with traders. Okay, and it's usually the new traders that try to add all these things to it and squeeze all the tools into, giving them a directional bias with the expectation, falsely albeit, that they're going to always know what direction the market's going to move every single day. And I'm going to tell you guys, I've been doing this almost 20 years, and I don't get it right every single day. Okay, you know what the secret is to my trading? I simply wait until everything lines up that I'd like to see, where the majority of all my tools, not all of them, the majority of the things that I'd like to see based on my understanding what markets suggesting to me. In other words, or what profile are we in? Are we overall ripe for a reversal? Are we in a trending condition? Are we in a consolidation area where, I don't want to be taking any kind of trading, with the expectation that we're going to have a trending type of event unfold, because we're going to be working within a large consolidation. I use that as my building blocks, and then by using the market profiling to give me the initial clue as to where we may be trading, then I start looking at actual individual market structure concepts on the 3 time frames that I use for whatever type of trading I'm doing at the time. Because I am dynamic, I move from one time frame or profile trading to another. One week I may be simply a day trader. In other weeks I'll be a short-term trader. And I wish there was a way for me to teach that premise from moving from one dynamic to another. I can't. So it may be disappointing to you, but this is a limitation on me as a mentor. I don't know how to communicate that. But I can give you concepts and approaches to do specific styles of trading, and you just have to wait for the opportunities where price action gives you that sweet spot in terms of being able to apply it. Okay, so by selecting a directional bias, this does not guarantee profitability. It's very important you understand that. Nor does it guarantee accuracy in either your trade direction and or your trade results. One trader's bias may be bullish. Okay, they're looking for buys, and that may exist inside the realm of another trader's sell bias. They both can be correct and make money, and even see both their respective profit objectives achieved. They both can be wrong and make money despite their respective profit objectives not being achieved. Again, it's not being about being quote-unquote correct. It's about being profitable. However, They both could simply lose money and neither trade idea come to fruition. There is no black and white. It's very important you understand that. As a trader, you must enter the gray and be comfortable with the less than perfect visibility. Trades with the foresight that you're expecting don't exist. Nobody has a crystal ball. I don't have it. I'm still trading on the probabilities, not the perfect scenario. There's no perfect scenario, okay? You, as a trader, will see trades materialize that will provide you plenty of profit-taking potential. Live there. Don't expect 100%. It's not going to happen, okay? Because I guarantee you, the only thing 100% is going to happen is you're going to go nuts expecting an impossibility. Find your time frame as a trader. Determine the market structure given for that time frame. Trade within that respective market structure and perform your targeting on the highest and mid-level time frames. And I promise you, you'll have more than enough trades laid at your feet. But it's not about trading every day, and it's not about capturing 1,000 pips a month. Okay, it's about consistently harvesting profits out of the marketplace, keeping risk low, and your action level low. Don't try to trade a whole lot. Keep your trading controlled. That way you're going to control your emotions, your expectations will be kept realistic, and you're going to live comfortably in the gray. Okay, folks, we are looking at the British Pound USD, or what is commonly referred to in my videos and throughout the Forex industry as the cable. This is a monthly chart, okay, and we're going to be discussing primarily the approach to developing your directional bias and looking for trades in that direction for all facets of your trading, whether it be position trading, swing trading, short-term trading, or day trading, or even the scalper. Again, I like to preface all these videos with the fact that while I do comment rarely on scalping, and you'll hear it mentioned in this video, I do not advocate that type of trading simply because it's too short-term for my personal taste. That's not to say that you can't make money, and it's not to say that you can't find consistent setups with these concepts for scalps. It just means that it's just not my forte. I wasted a lot of time and lost a lot of money doing that, in the beginning until I really found out what I was doing. And I just want to add that every time I mention it because I am actually strongly against scalping. And now my view of scalping is anything less than 20 pips. So if you can't make 20 pips out of the move, it's by my definition a scalp. Okay, so anything 20 pips or greater is what we're looking for. So that which defines my scalp. 20, 30 pips is my scalp. Anything greater than that is a short-term trade or day trade, and then obviously moving higher up in the realm of pip hauls greater than 100 pips. That's more or less my forte. I like looking for those types of moves. So even if I'm wrong, hopefully I can get 50% of the anticipated range of 100 pips I'm looking for, which is about 50 pips or so. And again, a lot of people are shocked when I tell them that that's really all I'm looking for the week. 50 to 75 pips a week. That's all I'm looking for. So again, have that in your notebook. You do not need a lot of pips to make a lot of money. You don't need a lot of pips to build wealth. You just need time and consistently doing the same thing over and over again that works. Okay, and we're going to be talking about all of the concepts that we've discussed over the last 3 years on baby pips. All of the videos that I discussed with top-down analysis, you have to revisit those, guys. If you haven't studied those and haven't really ingrained those primary steps as a technical analysis trader, you have to go back to that, okay? Because that's the roots to successful trading. You have to have a top-down perspective to limit the amount of false signals you would just inherently find if you just were staring at the lower time frames, 1 and 5 minute charts, which is predominantly what most novice and or new traders do, because they think they're closer to the market, so therefore their trades are going to be easier to see. And what's ironically seen is that they go away with thinking that Forex and trading by any asset class is too difficult or by their definition, after they lose their accounts, less than 90 days, typically they'll say that no one ever makes money. And hopefully you guys can see that that's not entirely true. There's people out there that do make good livings, and my goal is to help you do that. Okay, so again, I'm not a CTA. I'm not licensed to give you trade advice. These are just ideas to help stimulate some decision making on your part. Everything we're discussing in these videos, you have to take the responsibility, and the profits and or losses are yours, not mine. And I don't want the credit for your winnings, and I don't certainly want any of the credit for your losses. So practice in a demo account, and build the confidence that you need, and you determine whether or not these are going to be valuable concepts or advantageous for you to use with real money. And if you're successful, great. I'd love to hear your story, but don't thank me for it, because I'm not the one executing the trades. All right, so let's take a look at our first trading style and how we can arrive at a top-down approach. And it's going to be similar to a lot of the higher time frame videos here, but I'm really bringing you back to what's essential in terms of having a directional bias, because I get a million emails, okay, and you see it always creeping up on the forums. How do I know which way to trade? If I just knew that, I'd make $1 million every year, okay? And it's a lot easier than you think, guys, and it's unfortunate you have to overcomplicate it. And I'm not laughing at you, because I did the same thing. Okay, as an S&P trader years and years ago, I had that same thinking. If I could just get to the point of directional bias, what should I be doing today? If I just knew that, I'll be all right. And I was just trying to catch 2 or 3 handles intraday for the S&P. And when they're $500 per point, that's a good living if you catch a couple of them a week. So if you are in that rut in your trading, or if you just started and you've always wondered, how do technical traders arrive at the bias for today, whether they be a bull or bear for the day. Okay, and I kind of want to more or less take you away from that definition of whether are you a bull or a bear. Okay, you're neither. Okay, you're neither one, because you want to be able to go into the marketplace and just arrive at what you need to be doing at the time you trade. Okay, whatever that time frame is, whatever that framework. In other words, if you're a position trader, which is what we're starting with, your trades are going to be derived from finding the monthly, weekly, and daily market structure, key support and resistance levels, and then that's going to be your top-down approach. Okay, but even if you're not a position trader, you still want to start here, because it's going to be highly advantageous to you as a trader, even if you are a day trader or a scalper, because you're going to see a lot of the moves that are really wildly explosive moves one way, intraday. They are always seen with the institutional sponsorship that's being seen with the higher time frame directional bias. So it's important that you understand that it's not a boring or a waste of time for you to be doing analysis on these higher time frame charts, because it's essential for you to have this perspective if you really want to be catching and ferreting out these explosive moves in the marketplace. Because when you get a hold of one, it's absolutely mind-blowing how fast you can build up pips, get really handsome intraday wins, and it feels wonderful to be on the right side of the market. And if you can do that consistently over a period of time, even if you're 50% of the time right, and you have good risk management protocols, you will absolutely weather the storms of being wrong half the time. And I think by doing this, you'll find that your trading actually is a little bit more accurate than 50%, and you can be wildly profitable with just 33% accuracy. But if you have 50 to 70%, you enter a new realm in terms of profitability. And then obviously, once you have a higher time frame perspective, and you are more dynamic with your lower time frame analysis concepts, it's not unattainable to reach the 70 to even 90% accuracy level. Now, obviously, you'll go into a tailspin once in a while, and you have to prepare for that. And that may materialize in the form of a losing streak, or just a a bad run, okay? And it could be seasonally inspired. Like this time of year, I'm really not that aggressive in trading. It's the end of the year, it's around the holidays, so I'll scale back and or take myself completely out of the marketplace. And I've done that, and those that have been following me on the forums know that I'm completely out of the market right now. And if you have arrived at what type of trader you are, this module here, what we're talking about now, is going to be very influential in terms of, as a reference, go back to this periodically, okay? At least once a month. Come back to this video every single month while you're trading. At least if you're a brand new trader and you just started doing technical analysis and you've been following us for a short period of time, go back to this as a framework, okay? And it'll help you break down the market, look at the market in a structured approach modularly, and you'll be able to see that directional bias is absolutely not hard at all. It just requires you to be patient to see the setups that line up with the higher time frame premise, okay? So let's begin with arriving at a very simple approach to directional bias and top-down approach. All right, we're going to talk about the summer of 2012, okay? And I'm not cherry picking, because if you've been following me on YouTube and on Baby Pips, I actually called the bottom in the marketplace on both the fiber and cable before it actually happened. And it's all video documented. I even gave you the price levels, where it's going to go and where it was going to go once it reversed on the upside, okay? So you'll see a lot of those levels talked about here, and you'll be able to see those things actually done on a daily breakdown on analysis in advance on my YouTube channel. Okay, so again, I want to stick to things that you see me actually talk about and apply, so that way it's not like, well, it's great on the left side of the chart. No, guys, these are actual analysis that I did in advance. Okay, so I'm not making this stuff up, not put lipstick on a pig so you guys can be impressed with the left side of the chart. We're talking about something that has been documented before it happened. Okay, so now let's talk about the fact that obviously we're going to briefly introduce again the seasonal tendency. There's a seasonal tendency for the markets to create a low in the summertime. Okay, I'm not going to go over that here. That's all in the introductory video series that I did on Baby Pips. So just check out that first thread that's wildly popular right now. What every new and or aspiring Forex trader still wants to know. If you go to the first page of that thread, the very, 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 very single first post of that thread is an index list of all the videos and resources that I more or less shared with the community on Baby Pips. Now, there's a couple nuggets that are hidden throughout the thread, and that's for the folks that have the tenacity to actually go through the monstrous amount of pages to go through that. But you don't have to, but I think if you find them, they're nice little Easter eggs to get a hold of. Got a lot of insight to it. So we have a seasonal tendency to expect a low to form in the British pound, the euro. Again, we're not going to go over that here as far as why it's a seasonal tendency to go up, because I've discussed it other places. I don't want to spend too much time with all the things that we've already talked about. But here is the low that we're going to actually talk about. Okay, and that low is in the summer of this year, which is 2012, and is actually the June low. Okay, so the actual low was formed in the cable was on the month of June. Now, what I want to draw your attention to is the fact that if you go to the left side of your chart here just a little bit, see all these lows in here? Okay, and see the lows over here? Now look at the bodies of the candles here. And look at the lows over here. And if you stretch on over, all the way over here, you can see this is consolidation around that same area here. Okay, so what we're doing is we're going to identify a level of key resistance and support. Okay, so obviously we're going to be just eyeballing it initially. You have the 152.10 level, which is essentially this level here. Actual level for this data feed is 152.32. So essentially that's around the 152.30 level. Okay, so we could use the 152.50 in that area. I'm just going to again, ballpark it here. So here's 152.57. Okay, and you can see how there's a whole lot of tug of war back around that same level. If you go back over here, you can see the bodies of the candles and the wicks trying to reach for that same level. And again, the 152.50 is a mid-figure level that we like to talk about. All right, so we would expect reasonably to see some sort of a bounce around that mid-figure and around the large full figures, 152 even, 153 even. But notice that we have a whole lot of action around that 152.50 level. Okay, so what we're doing is we're actually looking at this low here, the lows in here, the bodies of the candles in here. This is a level of consolidation where there's a few short-term lows that could have been used for probable areas of support. But we're going to keep our original idea and premise to using the 152.50 level. Okay, and what we're going to do as we move down, again, we're looking at the higher time frame position trader approach, and we're going to use top-down analysis concepts. Okay, so we're going to start with the 152.50 level here. But before we get to that, what I want to draw your attention to is the range that at that point when we traded down into the summer months, we were inside of a larger range. Okay, and that can be seen here. Here's the low, and here's the high. Okay, can you see how that 50 level is the midpoint of that larger range here, this high and this low? So we're inside this larger range, and we found support at the 50 level. Okay, now I'm not trying to draw your attention to the fact that it's the 50 fib level. That's not the concern. Okay, the point is that we're inside of a larger consolidation. Okay, and thinking of market profiles, we had a trending profile, we had a reversal profile, and now we're in a consolidation. Okay, and we went into a smaller consolidation in here. Okay, so we do have this range to consider. Okay, and we have found support at the midpoint of that range. Okay, now think of our market profile concepts. Okay, now I taught a concept of Z-day formations. Okay, now if there was one thing I could go back and change, I wish I would have took the day part out of it. Okay, because it's the Z formation, which is what you see that's synonymous with consolidations. Okay, and they can tend to fall into the seek and destroy market profile. Okay, and again, that's a video module just for these specific profiles. Okay, so again, I'm not going to spend time here, but you can check those out and study more information about those. But while we're in here in these consolidations, okay, the Z-day formations or Z formations and consolidation is what you would expect to see in price action. So it's not limited to just a intraday or a daily phenomenon. You can see here on the monthly, you see that same formation happening in here. Okay, but it's interesting, I think, to note that at that 152.50 level, okay, we're seeing a whole lot of confluence of expectation of the market finding support at that same time frame. So now we have a seasonal tendency. Okay, price comes down into that 152.50 level. Okay, and again, the low on that particular month was the 152.67. Okay, so now we have this mapped out here. Okay, we've essentially went over the fact that we've been trending. We had a market reversal in here. Okay, and now we're into consolidation. So we're inside of a larger monthly consolidation. Okay, but we have discernible levels of support and resistance to work within. Okay, so now I'm going to keep these levels up. We've mapped out the higher time frame monthly chart. So let's go down to a weekly. You can see by going forward and moving into the June time frame, here's that June low right in here. We have price come up and come back down and found support at this particular level here. Okay, what I'm going to do is I'm going to take the fib off because it's not needed at this point. Okay, so now look what we have here. We have price finding support. Now by moving down to a weekly chart, we can more closely calibrate these levels. Now this is 152.50, but now watch what happens when we start moving up to these lows that are here. We have a low here, we have a low here, we have a low here. Notice what happens over here. Watch this area right here. Okay, we have this low here. If we move up to these particular lows, being this low here, the bodies of the candles here, you can see now we have a much more discernible range in here. So we have anywhere between the 153, because if you look over here, we got 152.97, and the low, the previous low here, okay, comes in at 152.30. So we essentially have about 70 pips of likely range in here that we would have to zero in and capture a more calibrated price level. So now, while it's still approximately 70 pips or so of potential range in here where we would anticipate the low forming, it's not hard in terms of now applying our levels that we're familiar with, the 80s and 20s. Okay, and we're going to introduce again the big figure and mid figure indicator. And what we're actually going to do is we're going to add some more levels because there's not enough on here. You can see how we have the 53 figure down here, and we have the mid figure that it didn't get to in here. So we have this range of 50 pips now. So you can see how we've calibrated from 70 pips down to a range of 50 pips. Okay, but we've identified this little area in here, and what I'm going to do is I'm just going to now highlight. Okay, and we're going to use the 53 and the 52.50 level in here. Okay, now what I'm drawing your attention to is the fact that we have this low in here, the low here, and the low here. Okay, so we're working within this 50 pip range in here. Okay, so now when we drop down to a daily, okay, which is the next level when you're a position trader, we're going to go down to that time frame, and you can see here, this is the daily, and now we have the bodies of the candles here. See how we have all this consolidation in here? Because all we're doing now is we're just mapping out from the higher time frame, monthly, to the weekly, to the daily, and we're calibrating high odds support and resistance levels. Okay, I get questions, how do I know how to find key support and resistance levels, and what do they look like, and what do I do to do it, in my own charts? Well, I already have a video module for that, and it's silent, but I give you all the details that you need to go through the steps. And this is really, again, one more example of how I do it. And again, I'm not asking you to take my word on it. Go and look at all the videos around this time frame, and you'll actually see on my live stream channel and on my YouTube channel that these are all particular points in the marketplace where they were called in advance. So again, we're not doing cherry picking. Now there's a gray level in here, and this is the 152.80 level. Okay, so we have 152.80 as a good level to be looking for, and we have the bodies of the candles and the lows down here, and those come in at 152.75, 152.79. Okay, so around that 80 level, okay, is a good level to be anticipating a bounce. Okay, so now we have essentially the 152.80 to 152.50. So now we've reduced it down to 30 pips. Okay, so now we're going to zoom down into the 1 hour chart. Now you're probably saying, well, why didn't you go to the 4 hour? Because we're a position trader, so there's no necessity to look at the 4 hour, because you've already arrived at the likelihood that you're anticipating a bounce in support. Okay, and you're looking for price to provide you a signal at that time frame. Okay, and here's that particular area where price comes down into that June low. Okay, now what I want to draw your attention to is we've identified that higher time frame 153 to 152.50 level initially. That was that 50 pip range, and we reduced it down to 30 pips. So here's that 152.50 level, this dotted line here, and here's the 152.80 level. Okay, so inside that area we're expecting some sort of a low to form based on all those previous old lows from all the monthly, the weekly, and the daily chart. So we broke it down and we mapped out the marketplace where there's a high probability to see specific key levels. Okay, now it's not imperative that you pick the right one. You wait for the market to tell you which one is the right one. Okay, I understand there's a lot of respect for me on baby pips, and I appreciate that. But unfortunately, some of the newer folks, okay, and so maybe the guys that's been around for a long time and still have this struggle for a while, they put an S on my chest and they make me much more than I really am. Okay, and I appreciate the enthusiasm, but I don't know all the time where these things are going to reverse right to the pip. Okay, so don't have that in your mind. I get lucky a lot, okay, and sometimes I'm able to call highs and lows, and it's, you know, it's impressive sometimes to myself, but that's not what your goal is. Okay, what we're talking about here is how you actually arrive at a directional bias where the market's already proven to you where the high odds likelihood of it trading to is. Okay, so again, remove the necessity and the putting yourself in a box where it has to provide you the actual level. Forget all that. You don't need that. Okay, and what we're about to show you here is going to prove that to you. Here's that seasonal low we anticipated. Okay, we saw price trade down to those particular levels. Okay, and we're anticipating a bounce. That's what we're looking for. Okay, if you're short all through here, you're just looking for targets down here to take profits, right? But if you're a position trader and you just sat down your charts and you want to resume trading and you look for a long-term trade, a seasonal low in the summertime is a good opportunity to get, hunting for this type of setup. All you're going to do is wait for a low at a predetermined price level when a time of year, seasonally speaking, okay, where we are likely to see the market move for a long period of time. And that's what the impact of seasonal tendencies will provide for you. So now we have price coming down into this June low, okay? And then we have this nice reaction here. This is what you wait for, okay? This is what you wait for. Now watch. I'm going to take the big figure, mid figure indicator off, because I think right now it's going to, number one, it's going to distract me, and we can't have that. So you see this price rally up in here, okay? Look what it's done. When it rallies up like this, it blows out the market structure swing high here. Now again, we're looking at a 1 hour chart, so this is what you would need. When you see that happening, okay, we now have confirmation that, hey, look, market structure is now broken on a 1 hourly basis. This is the swing that breaks it. So this is the impulse move here. Okay, so this is your range. Okay, and you probably already understand where I'm going to go with this next, but this is what you wait for. You don't chase it when it rallies up like that. Okay, you're a position trader. You want to get in sync with the higher time frame trade. You want to be in there for a little while, not just a day trade. You have a job, you have family, you have kids, you got soccer practice, or you're a soccer mom, you're a baseball mom. You can't be in front of the charts all the time, but you want to have an ability to be able to trade and take some, take some trades out of the marketplace and not trade all the time and still be able to capture some handsome moves. Well, this is how you do it. You have the market structure shift here, this swing high here. When it breaks above here, that's what you've waited for. So now all you're going to do is go to your fib, grab your low, pull it up to the high of that range, okay, and you drop it. this is what you have here. Now again, this is a 1 hour chart. Okay, when you see this, you could have this on your smartphone, okay, your iPhone or your Android or whatever, that allows you a alert to be sending you a text when price comes back down into that 62 level or approaches it 10 pips or so. Okay, you want to be looking at the marketplace, or you just simply put a limit order down in here. Okay, so when price comes down to that point, you're going to be buying at a limit. Your risk is going to be from that point and 10 pips below here. Okay, so what does that equate to? Well, let's look at that. If you go in with a position trader's mindset, okay, and you're going to be buying at the 62, and you want 10 pips below here, okay, your stop is going to be 152.57, okay, 152.57. Now the risk, total risk, is going to be 76 pips, okay, 76 pips. And you're probably saying, whoa, that's a lot of pips. Okay, I understand, but if you're a position trader, what are you going to do? You're going to be scaling back in your lot size anyway, right? So there's nothing wrong with taking this trade with a 76 pip stop loss. If you're trading with one mini, okay, you can trade with that. You're only assuming a risk of $80. So there's nothing wrong with that trade, okay, and you'd be able to be positioned for a longer period position trade. Now again, obviously you can go down and look into the smaller time frames, okay, utilized with day trading and swing trading and short-term trading to even narrow down that smaller risk, okay, but we're not going to do that here. The only thing we've talked about thus far is we're arrived at a directional bias, so now we've expected this to happen. Okay, so at this point, if you're a position trader and you have a job and all that business, this is where the market structure shift takes place. And then it comes back, gives you the buy signal, and then starts to rally up. Now, what you're doing at this point is you're going to start mapping out all of the intermediate term and the short-term highs and lows. Okay, so now we have this low here with the previous low here that's higher, and now we have a higher low here. So this makes this what? An intermediate term, or what we're hoping to find, a long-term low. Okay, and you have a higher low here, and you go back here, you have a higher low here. That makes this qualified as a long-term low. So now watch what happens. We have a low, now we have an intermediate term high here. We could see if price runs above this high eventually here in our position trade, which is what we see here, we could see a move that's comparable from this low to this high added to this high up. Okay, and what do I mean by that? Well, let's take a look at this. And we have this range here, and you've seen me do this before. These are all measured moves in market structure. Okay, and scrolling forward, and it'll probably be better if I take it out. We have price still meandering in a larger consolidation, and let's go out to a 4 hour, a little bit easier. You had to sit through all this, but again, you're a position trader. You're not in there every day. You're in there for a longer term price move. Look what happens if you go from this point over here, go straight on over. Boop, you get this high right there. Okay, so if you're a position trader, you could have done a long here and reached for this particular high here as your first profit objective. Okay, as a position trader. So what does that equate to? Well, let's look at, we have price approximately around this area here. I'm not going to give you the exact pips. It's not important here. But we're looking at a move for a first profit of 575 pips, approximately. Okay, so if you're doing double tap as your specific trading approach, taking first profit here, okay, your first profit is 575 pips from your entry. Okay, now when you see this swing here, okay, again, we've now measured this initial move here, but now we have this retracement that you would have had to absorb. Okay, we're going to talk about risk and stop placement and risk reduction and all that, and we're going to apply all those concepts again through all of these different times of trading, so we're not going to talk about that here, but I promise you we'll be bringing it up. You have this low to this intermediate term high here, okay? It comes down right into a sweet spot, and you would be expecting this to unfold, anticipating it to unfold. And then as price rallies up and breaks these highs in here, okay, we have further evidence to suggest that any lows retraced back in here as we make higher short-term highs and intermediate term highs. Every time we do that, that will allow us to apply market structure concepts to reach for new buying opportunities. Okay, so while you were buying here and you saw this range from this high down to this low, when we saw the retracement back here, this is another opportunity to buy more. Okay, so you can get long and build your long position up, or seasonal position trade even to a larger degree. Now, assuming that you had this understanding also and you applied market structure, you can now start applying your higher level profit objectives by taking this high, and I'll have to fix that fib in a second, pulling that from the high here down to that low, and we have a 200 extension up here. Okay, so that'd be a nice second profit level for a position trade. Okay, if you utilize the expansion tool, you take the low that forms here and you apply it to here. Okay, and your 200 extensions up here. So you're looking for a really long-term profit objective that's way up there. And we're still possibly reaching for that. Okay, which is, I think, is rather significant that it's above this high here. We poked above it here, and we talked about that real time as a sell, and then ran down. But that's not the point of this video. I'm plugging live market calls, so I apologize for that. It's not my goal here. Let's take this expansion tool off. Okay, so you can see how we had this trending move, reversal, and consolidation. So now we're applying the market profiles, market structure. Okay, so now we have a directional bias long-term back here in the beginning of June. We are still in the summer months in July. Okay, we still expect a seasonal rally. Okay, and you see this run up. Now, we also can apply standard price patterns like ascending triangles, which is what you see in my video. I talked about this in the video, and then talked about projections, which led to this retest of this old high back here. And again, I did all that back in June, okay, late May, early June, and I was calling these highs back here before they actually happened. So now let's take a step back, okay, and think about what we've covered. Just for position trading, okay, we could look for entries here, okay, and using market profiles and market structure and blending all the things that we've talked about in other videos, okay, we arrive at a directional bias. We're looking to get long. Okay, once we take out old highs, you just go to the left side of your chart, and there's going to be new old highs that you have to reach for. If the price gets above this high here, from here, in other words, we're rallying up, and we make this high and starts to retrace, and we go into another optimal trade entry, from this buy, where's the objective going to be on the upside initially? It's going to be this old high back here. And you see it fails here initially, comes back and retests again. But notice what's happening. Every time it comes back, it's providing you new buying opportunities. Okay. Then we have it break this high here right there. Then it comes back and finds support there. And then market structure continues to keep making higher lows as it reaches for new highs going higher. Okay, so what is it pressing for? What's it reaching for? It's going to reach for an old level of resistance, which is back here. Okay, so now we would be reaching for this level if we're long here. And had you done that, you would have been able to get some profits, very handsome profits here. And if you were using that as your secondary exit point, again, not using the ideal point of entry on this eyeball on it, if we just use the old high back here, that's 965 pips. So if your first profit was 575 and your second profit was 965 pips, good grief, you're not doing a whole lot of trading, but you're also taking off the market a huge amount of pips. So if you're just now getting yourself acclimated to trading and you have a full-time job and you maybe have kids you got to take care of, there's no excuse why you can't take profits out of the marketplace. But the point is if you start with this premise, it'll help you when you start applying some changes to your life that you hopefully can do and allow yourself to get more closer to swing trading or short-term trading when you actually have a lot more participation in the marketplace. This approach to analysis will provide you a wealth of insight, huge amount of insight, okay, because we're going to take a huge step, okay, and those that have missed it up to this point in the last 3 years on my journey with you guys on baby pips and sharing, you're going to hopefully have that epiphany. Okay, it's going to be, whoa, there it is. It makes sense now. Okay, we have been talking, okay, most of this video just about the monthly, weekly, and the daily, and now we're just spending a little bit of time on a 1 hour, 4 hour chart just to illustrate, how these things work out using the higher time frame. So we've covered the position trading, okay, and we've arrived at a directional premise here, okay. So if you're a position trader, this is how it could have been done, okay. But now we're going to get ready to take a huge step. We're going to take a huge step forward, okay, and apply even more detail to this same premise. Okay, so now what we've done is we've essentially mapped out a time in price, okay, and now I'm going to, for the sake of honesty, because I wouldn't have known exactly when time-wise it reached this area in terms of price, but I extended it past a little bit. But this is the high we would have been aiming for. So from this point in here, the range is the old high here and wherever we would have entered on a higher time frame positional trade. Okay, so now watch what's happening. We're going to be now moving into the realm of swing trading. Okay, so how do you arrive at your directional premise for swing trading? Well, it doesn't take rocket scientists to figure out that if we're higher time frame positional trading, expecting this type of move higher, okay, and again, it's very, very, very important that you guys go back and look at the videos that I did during the late spring and the whole entire months of August and June and July. I called this market higher using what I'm sharing with you now, okay? So you know it works in advance. It's not like I went backwards and I'm giving you the best of the best. This is how this is done, okay? And I use higher time frame directional premise to facilitate all of my other trades, okay? So now let's break this down into a means of swing trading. So now we're going to change to a daily, okay? And now you can see by looking at the daily, this is that portion of the market, okay, we've mapped out for a high probability of seeing a buy program. Okay, now buy program is when you look primarily for buys. Okay, the direction is most likely to have least resistance going up. Okay, so that's basically what you're doing as a trader. When you map out the marketplace, you're looking for the least of resistance, because that's exactly where the market's going to go. Okay, whenever there's the least amount of resistance, that's the highest probability in terms of trade direction. So that's one of the easiest ways to remember where is the open spaces in the charts. Okay, once you break these highs, look what you had back here. You have a very short-term high here, and then you had some consolidation there, but look what happened after that. Boom, vertical, because it was filling in all this price action. There was no discernible, okay, support and resistance. Now there was short term that you could have used, obviously, and as we look in the smaller time frames, but the point is there's very little resistance in terms of that higher time frame price move, because once we found consolidation here, there was accumulation underway here. We talked about this real time. Okay, that means the big boys, the institutional players, okay, they were accumulating longs in here. And there's a lot of folks that were calling this market low here. Lower, it's going to go lower, it's going to go lower. They called the fiber lower here. Not us. We knew, looking at the charts, that there was accumulation going on the way. Now, with that premise in mind, all we did was wait for price action to prove to us that it was going to go higher. Okay, so now we have the daily chart here, and we're moving down into a swing trader's mindset. Okay, so now you're not so much a position trader. You want to have a little bit more active role in trading, and that means your trades are going to be a little bit longer than 1 week. Okay, so it could be 1 week to a month. Let's break this down and take a look at how you as a trader could be a swing trader. Now I'm going to have to unfortunately change the color of this rectangle because it's just a little too much in terms of blue. There's nothing wrong with blue. I just can't have it looking like this. See what that does. It doesn't help me out either. Let's go to a little bit darker. And let's go with purple. It might work. Yeah, that's all right. That's good. And if it doesn't work for you guys, you know, suck it up. So we have the market structure shift that took place back in here in the beginning of June. Okay, so now as a swing trader, okay, what you're going to do is you're going to wait for your higher time frame directional premise to come underway, and using the daily chart, that's your primary higher time frame chart. Okay, and assuming that, and you're looking at price making this rally up here, okay, you as a swing trader, the setup you would be hunting was this, from this low to this high right in here. Now again, I'm going to counsel you to go and look at the videos. You'll see me with a trade long here, and it was a swing trade. Okay, and this is the reason why I did it, because I anticipated this range here, the retracement back. We were still within a higher time frame probability of at least trying to trade back in the range that was from this high to this low. So now again, all I'm sticking with is that higher time frame premise or a bullish scenario. Okay, so I'm expecting bullish prices. So now what am I going to do as a swing trader? I'm going to be looking for a trade like this, okay, this low to high, and I'm going to be looking to get long here. Okay, so now watch. We're going to go down into that same little area, and we'll just take the 62 to the 79 and block out that little area here. Okay, so we have identified a level where we would expect to see the optimal trade entry form. Okay, we saw old highs in here, old lows in here, so we do know that around that 154.20 level, okay, or 154 figure, that's highly likely that we will see a bounce there because we're inside the optimal trade entry 62 to 79 retracement level in the fib based on this retracement of this high and this low in here. So we traced back into a deeper retracement while still being in a higher time frame bullish scenario that we just mapped out from the monthly, weekly, and daily. So now let's drill into a 4-hour, which is the next chart that we utilize. Okay, so now we have that little area down in here. Okay, so now you're going to apply all the concepts we've already talked about. Okay, you see this low to this high in here? If this is the area we're hunting for a possible low to form to get long on that higher time frame daily, okay, to hunt a optimal trade entry long, look what happens if you take that low and you apply one of our trademark patterns, ICT Grail. Oops, yeah, well, we'll use it. Here's the 62% retracement level here. Okay, and it's overlapping with this level here on this low. Here is the level is the 100 level. This is how we hunt the ICT reflection. So we have a confluence of a lot of factors here suggesting this is going to be a low. And again, please go back to the videos during these months, okay? When I'm doing Pro Traders Clubs and market reviews on the weekend, you'll see me talk about these and show you, okay? And many times there's examples of trade entries and actual live events where I actually did trades and show you the results of it. But here you have a reflection pattern overlapping with a higher level OTE, okay? So this is your entry for a swing trade, okay? But if you miss this one, okay, if you miss this one, we're on the second chart on our higher time frame for swing trading. The daily is the highest and the 4-hour is the secondary, and this is what we're looking at now, the 4-hour. But if you miss this, how do you take action? Think. How do you take action if you want to be a swing trader and you miss the easiest entry in terms of the higher time frame daily? What do? You wait for market structure to prove to you that it's going to go higher, okay? And that's this high right here. When that high is taken out here, okay, you don't chase after it when it's rallying up like this because you're zoomed out to a daily and 4-hour. You're going to allow it to run up and give you a range. And then when it starts to retrace, what do? You map out where the next signal is going to likely to occur based on price, okay? And what does that look like? Well, you take your fib, and here's the low that you missed, but you maybe have anticipated it. Here's the new range, okay? This low to high. Your directional premise is still what? Long, okay? You want to be a buyer. So you wait for price to come down. Look at the overlapping of 79 and this old fib here. We have a nice confluence of the optimal trade entry right in here. Okay, so now you're getting long at the 154.80 level, would be handsome level. You can see it over here, or 155 figure. Okay, you can get long in that and have a rather manageable stop. And we haven't gone down to the 1-hour chart yet where we can actually zoom in and get a tighter placement on our entry and stop, but we're just going to eyeball it here for now because I'm going to talk about if you do take this trade and you want to be long, what's the targets? Well, think. We now have this range. We have this high to this low, okay? And you can see how price is reaching right back for this high here. With what? Dynamic, explosive price action in the direction of the higher time frame premise. You see this? This is the type of trade you want to be in. This is institutional sponsorship. This is where the big boys are behind it, okay? And what happens is they get in there and buy a whole lot of it, and okay, and they take some profits off, but they don't want to miss another opportunity to buy. So they'll stop buying and allow the market to fizzle down. Okay, and where does it go? Right back to that same entry point where they can buy more and they accumulate more of it. And what do you see again? Immediately it rallies up away from it. And again, they put the the brakes on a little bit because they don't want to have too much attention drawn to what they're doing. So every time it comes back, they're buying more of it, buying more of it, buying more of it. Okay? But now let's talk about this little entry point right here. All I'm doing is borrowing this rectangle, and I'm going to highlight this little area here on the 1-hour chart, and that's the lower level chart for swing trading. Okay, now watch what happens. We have price trading inside that little area here, okay, at that higher level optimal trade entry point. Okay, price rallies up and then comes back down inside that range. What do you think is going to happen right here? You're a swing trader, right? You've mapped out your directional premise based on the higher time frame. Here is your 79, your sweet spot, and your 62, and there's your explosive rally up. And it doesn't take long to get back to these old highs here to get profit. Now, what does it look like in terms of pips? Well, if you get in here at the sweet spot and just take profit over here, that's 250 pips, 260 pips or so at the best case scenario on your exit. Okay, 260 pips. There's nothing wrong with that. And it doesn't take but a few hours really to get to that point. So inside of a day, 260 pips, man, that's good. And that's a swing trade that you could take using the higher level time frame directional premise. Again, your directional premise should hopefully by now prove to you, if you're looking at the higher time frame charts, if you just trade just like this and trade in that higher time frame directional premise, you're not going to trade every day. And that's okay. Unfortunately, a lot of you guys think that you have to be trading every single day, and you don't. Okay, and it's better if you didn't. Now, what do we have over here? Price comes back down. Okay, and let's look at the range here. Again, we're working with the higher time frame premise that we're expecting bullish prices. Okay, we have I just lost my fib. Let me. Okay, here it is. Using this low here, okay, on the 1 hour chart, your optimal trade entry is up here. Okay, now think, you're a swing trader, right? Are you going to do your trade entries on the lowest level? Not without consulting your higher level, right? So think, before we even go back to that daily chart, what do you think the range is that you're going to be utilizing? This is one that you could use if you just stick to the lower time frame. And this is illustrating what happens with you guys looking at 1 minute and 5 minute charts all the time. You can't see what you need to see when you're so tight to the market. You see this old low back here? That's an intermediate term low. We have a low with a higher low and a higher low, with higher lows behind it too. Higher low here, that's higher than this one, higher low here, and now we're expecting a higher low, right? We're hunting it. So this is going to make this a long-term low. Okay, now watch. You have this low to work with, and now this high. So this is the true range, this low and this high. Remember, okay, this high and this low. Watch what we do. We're going to take the fib and put it on the true range, which is the daily. You'll see it now clearly. Let me zoom in, sorry. Okay, see the range here? We have the low up to the new range high. And as price drops back down, we're going to take this other fib out because it's a little too much going on right now. You can see how we go right down into that sweet spot. And then there's your rally on up for your nice entry point for a secondary entry. Okay, so you can see the low to that high. Here is the swing down into that sweet spot. So we can actually take that and put that here. Okay, and it's mapped out where the optimal trade entry is going to be. And now if we go down to the 4 hour, you can see how price comes right down to that point. Now, if you see what I'm talking about, if you're using this low to this high, this might have spooked you. Okay, but you've mapped out your trade idea from the higher time frame daily down to your 4 hour, which is your middle level for swing trading, and then down to the 1 hour. Okay, which is where we trade into here. And now we can fine tune our entry. Okay, and what does that look like? Well, let's take this and don't even pretend, just pretend this is not even there. Okay, we don't need to see this to reference what we're doing on the higher time frame. What we're looking for is the rally away, which is what we get here, and then we have this retracement down. So what do you think is going to happen over here? Well, if you take the fib, pull it from the low up to the high, here's your sweet spot. Your 79 doesn't get touched here, but you do get the opportunity to trade in here inside this hourly candle, which forms a nice hammer. Okay, and then you have a rally up. Okay, now if you miss this opportunity here, okay, this is a swing high. Watch what happens. If you miss this one, it breaks that swing high here, right? See this high here? It's broken now. So now we have another shift in market structure that's now confirming bullish prices. So now when price rallies up and it starts to retrace, okay, if we miss this opportunity, we now have a new range of here, this low, to this high. Pull that up to the high here. And here's your 62% retracement level here. Okay, or you could use the low that's formed right here. Okay, this is actually a New York Open kill zone, so you could use this swing point for a reference. Again, go look at the Fibonacci Concepts video, and it'll talk about where I pull fibs from in case this is going over your head. And now you can see a more higher level symmetry in price action here, where it comes right down to the 79% retracement level, and here's the 62. So there's a very nice, handsome sweet spot here on the hourly chart. Okay, so you could be positioned as well for a swing trade there, looking for higher prices. So you can see how just by utilizing the higher time frame premise that you can ferret out trades with the directional premise based on that position trader's mindset. Okay, and really it just equates to the top-down analysis that's needed, okay, to be consistently profitable. You need to be doing the same thing over and over again, and you're looking for the higher level charts to dictate where your trade's going to be and what direction. Okay, now again, you can swing trade reversals. Okay, here's a high here, and you could done a turtle soup here and swing traded that down into the optimal trade entry here. I'm not teaching that here, but you certainly can do that. And the same thing here. Here's a high. When the price rallies up, makes that new high. Overall, you're bullish, higher time frame, but you can trade these turtle soups down into a retracement and still be considered a swing trade. Okay, but that's advanced stuff, and I'm not even going to try to teach it to you. Okay, after time of doing technical analysis and trading, you'll see when, and you'll know personally when you are able to do these type of trades. But I'm teaching you to trade with the institutional sponsorship that's usually seen on the higher level charts like monthly, weekly, and daily. Okay, so now what we're going to do is we're going to swing down to another shorter term perspective in the same area of price. Okay, now how many times have we shifted gears in terms of directional premise? Zero. None. Okay, we've arrived at the higher level time frame directional premise. Okay, and we've established our bias based on that. We ain't guessing, guys. Okay, we're sticking in one camp. Okay, and it's based on where the least resistance is going to be, and it's found by studying the higher time frame charts. Okay, so now let's take a look at a short-term trader's mentality, and we've mapped out this area here. So now what we're looking at is a 4-hour as our higher level time frame. Okay, here's the 4-hour chart. Okay, and much in the same capacity, what you'd be looking for is key support resistance levels. Okay, and we're going to assume for a moment that we understood that this is a intermediate term low because we have higher lows here and then higher lows on either side of it. So now we know that we have a possible market structure to imply at least a low to the high in this market structure here. Okay, so we have this range from this low to this high. Now it could have been the high that's formed over here if this high was higher, and that would have been a reference point I would use for what I'm about to do. Taking the high down to that low, okay, at some point when this high is taken out, again here, you can see it finding support here, we would be reasonably expecting a move to these levels up here. Okay, so just on market structure alone, we have directional premise indicating that we have a likelihood of fulfilling a upside objective around the 161.50 level or so. Okay, so we have a whole lot of room trading in here to get to that point. There's a lot of pips available as a short-term trader doing that. Now again, not losing sight of this old high back here as a possible upside objective ultimately on the higher time frame long-term position trader's mindset. Now using the short-term trader's 4-hour, okay, all you're looking for really is new range low to high, okay, and you're going to be pulling your fibs from that in the higher time frame directional premise going higher. Okay, and all you're doing is looking for clear structure swing points that make lows to highs and then pulling your fibs from it. Look how many times, I'm not even going to draw it on here, look how many times the market had given you optimal trade entries in here. Just in this point here, all in this little area here. That's 100 pips or so a couple times that was laid on the table just doing short-term trades, pulling optimal trade entries on these swings. Okay, but we're going to assume that you weren't that nimble. Okay, and you've seen this is a nice area of resistance. Okay, and you want to be safe. You want to be trading short term once this level, because there's no guarantee that this is going to provide a support level, because it's going to be a resistance level initially, right? Or we would expect it to be. So as price goes through it, this is where you would trade as a short-term trader. Okay, here's your short-term trade here. Now, what makes it a short-term trade? Well, number one, we've broken resistance, now support. We're inside of a higher level directional premise on the higher time frame position traders mindset and swing traders mindset. We now have a very high likelihood of catching a bounce here. Even if it's ultimately going to go up to this high here and fail, this has given us a short-term trading opportunity, okay, which is all a short-term trader is thinking about. But now let's take a look at market structure in terms of the setups. See this old high here? Now granted, we have this high here and this high here that we noted with the resistance level, but prior to that, it's this one. Okay, you see that? So we have this level to contend with. This level actually becomes the 157.44 level. Okay, so that's a nice level of anticipated support. So if price does slip below that, we could at least see it trade down to that point. But the point we're going to illustrate is this is a reference point that you can pull a fib from. Remember hidden optimal trade entry? You're using market structure and fibs. We have the 79% retracement level converging almost right to that same level of support and resistance. Okay, let me put that on a little bit better. Okay, right on that high here. You can see how the 79% retracement level is almost converging right with that particular price level that we've mapped out with support and resistance levels. Now let's drill down to the second chart for short-term trading, which is the 4-hour. This is your mid-level time frame. Okay, you can get a little bit closer view of what we're describing. Okay, and you can see how price slips through it here. Okay, but you can see the reactions at that same price level. Okay, again, we're going to play devil's advocate. Say you missed this one, which is fine, because guess what? If you want to be a high odds consistent trader, this is what you would do. You would wait. I know that's hard for you guys to get in your head. Patience is a very difficult thing to teach. You have to be trained. You have to sometimes be beaten mercilessly, okay, until it's ingrained in your psyche that you have to wait for certain things sometimes, okay? And success in trading, unfortunately, you need to do these types of things and learn to wait, okay? But if you see this bounce, this is what you would expect to see. You want to see it react at that price level. But now watch. Go to the left side over here. See this short-term high? There's your break. So now you have short-term market structure shift bullish. Okay? So now you are in sync looking for now new buy signals. Okay? So this high here, when it's broken, okay, what you're going to do is start pulling your fibs on the swings. Now we're in a 1-hour chart. Okay? So again, you're using the fibs on the 4-hour or the 1-hour to time the setup, or establish the setup, the stage, in other words. And here's your range here, this low to high. Your 79% retracement levels laying right here, converging with the level of resistance that we've already mapped out. So looking to be buying around the 157.80, which is not even the sweet spot. Okay, that's just an institutional level we like to watch. The 80s is a nice level. You could be a buyer at that particular price point. Okay, and then there's your short-term trade. What's your position objectives? Well, if you get in at the sweet spot, getting back to this old high here, there's 80 pips. Okay, now if you go back to this old market structure swing high here, okay, that retraced before we got down to this level of support and resistance, this level here, if you took profits there, that's 120 pips. Yeah, 120 pips right here. And there's two very easy levels to derive a split position. In other words, if you're using double tap, you could take profits here and in here. Okay. Now let's look at how we have a higher low here, we have a low here, we have a higher low here. So we have market structure implying that we're hopefully going to see higher lows and higher highs. But as we start moving forward, okay, and I didn't do this with the other time frames because I wanted to move along, but you're going to start seeing it become more dynamic. As price is moving in the higher time frame directional premise, you want to be mapping out the resistance levels. Once they're broken, we anticipate them to become support and resistance. Okay. As the market begins to move higher and higher and higher, all these retracements are new opportunities to take short-term trades going along. Now, if you look at the vertical lines now, because now we can start looking at intraday divisions in terms of where particular days of the week are forming, you'll start seeing that what we've talked about for 3 years now, how the week's low in a bullish scenario many times will be between Sunday's opening and Tuesday's London Open. And if it's not by Tuesday's London Open, it's certainly going to be by Wednesday's London Open. Typically, there's a 70% chance that you're going to see it unfold this very way. So again, don't take my word on it. Look at your charts and you'll see it. But the double lines here are delineating Sundays. Okay, so we have a new week here with bullishness. We have Monday's trading, Tuesday's trading. Here's Wednesday. Okay, so here's the low that you could have traded as a short-term trader. Okay, and just there you go. Short-term trade, couple days, up to a week. Okay, entering on Wednesday. Here's Thursday. Here's Friday. 3 days. Let's take a look at what the pip haul would have been on that. And again, you're a short-term trader. This is the highest level and lowest level available to you. As a short-term trader, intra-week, there's 210 pips. Okay, in 1 week. Now, again, we have another scenario here. We have a new level of support resistance. So you can just take this level here. Let's just draw a new one. We have new support resistance levels to work with. Short-term high here. It breaks through. This level here, same application of fib using old market structure high to a new high here. Here's your 79-cent retracement level here, right to the pip. Okay, and you want to be a buyer here with first profit of this old low. I'm sorry, this old high. You just did that. Again, the directional premise is what, guys? We've already arrived at it based on the higher time frame that we're looking for buys. Why? Because the institutional sponsorship that we would hopefully like to see in all of our trades are going to be looking to be buyers. So here's 67 pips first profit. Okay, and then the remaining, the low forming here for this week on Monday. Okay, so all of our rules, you can see them unfolding to the letter. Okay, and if you're a short-term trader, you could take first profit here and then hold for the weekly range. What? Yeah, hold for the weekly range. Take some profits around Friday. Sure, let's take a look at that. And I know a lot of you new guys are saying, "What? This sounds unbelievable." 272 pips again inside the same week. Okay, you're a short-term trader. That's a week or less. Okay. Now we're approaching these levels where that old high was. Okay, that around that 163 figure. Okay, so when we trade up to that point, okay, we want to be a little bit more leery of taking new buy signals until we can see that old high being broken. And that being this high here, which we didn't do but by a pip or so. Okay, so when you see this event, okay, like this, there's a whole lot of opportunity to trade, but there's a whole lot more opportunities when you should not trade. Okay, and if you haven't learned that over the last 3 years, it's time to learn it. Okay, because it's important that you understand how the markets work with the higher time frame premise in mind, working off a higher level key support resistance levels. The banks and the big players are working off these higher time frame charts. They couldn't care less about what your 1 minute chart looks like. Okay, your 1 minute chart means nothing to them. We as traders can use those to zero in on high odds entry points, but they're not guarantees that that's what the banks are using. In fact, they're not. Okay, so we've mapped out the position traders mindset. We've mapped out the swing traders mindset. We looked at short-term trading. Okay, so now let's zoom down to the lowest level, day traders and or scalping. Okay, and now what we're going to do is we're going to use the 1 hour time frame as we have here, and we're going to look at that same scenario. Okay, and that resistance level here, and we have this little move right here. Okay, this little move in here. We're going to break that down, and this happens to occur on September 7th of this year, 2012. Okay, and we're going to go down to our 15-minute chart, which is our mid-level. Okay, and actually I call it the 9th. It was actually the 7th, sorry. This is a Friday. Okay, I generally do not like to trade Fridays, but I'm just going to give you an examples how, utilizing these concepts, you can see trades that are intraday in line with the higher time frame premise, and how they could materialize and show some significant price gains. I'll let you look at the calendar, figure out what this is, do some homework, guys. I'm not going to tell you everything. Again, this is a Friday, so again, have that in mind. But in this area here, you could be hunting a setup to go long, okay, based on just simple optimal trade entry, okay, but utilizing the worst case scenario entry, not the best. We're going to use a 62% tracing level here. With a 30 pip stop, you're down here. You didn't get stopped. Okay, your stop would have been 159.16. So you would have been preserved in this instance. Okay, but that's using it with that range. Okay, here's our old level of higher level support resistance line. Okay, all I did was drill down to that 15-minute chart. This level and this high, okay, becomes significant. Why? Well, because this is a range based off of higher level key support resistance levels that you can't really see that well. Obviously, you're getting hints of it here, but if you're zoomed into a 15-minute chart, you can see how very quickly price action can be skewed. It hides from you right in plain sight. Here's your range, and suddenly you get perfect symmetry. Okay, this is what blows all the guys that are just discovering me on the internet. They're like, this is crazy. I mean, you're pulling out so precise points, and it's nothing except for using a higher time frame premise, drill down and looking for higher level support resistance levels, pulling for your fibs. Because think about it, if this is a higher level resistance level, once it's broken, it's going to act as support, right? Okay, well, it doesn't find support again over here, but it's trying to get down to that point. We want to see what? If we're bullish, we want to see higher lows. So it's advantageous for us to see the higher low form. So we're stalking that. And that's why these types of setups unfold where it looks like voodoo. Okay? We don't want to see it come back down to that level, because if it does, it's probably not going to go up even higher. It can, but the higher odds are if it makes a higher low, that's where people are going to be looking to be buying. Okay? You want to be buying strength and selling weakness, and this is an indication of strength because it's unwilling to go lower when perhaps it might indicate that on a 1 or 5 minute chart in that little area of price action. And you can see the extrapolated price move here, and then there's nothing wrong with just using the same concepts we always talk about, using a high to the low with a higher time frame directional premise, and our swing trading. Here's 162 extension in here, very handsome opportunity to take your profits. And again, if you've been following me, obviously these are nothing new. I've not created a new rules or anything, but we're just applying the concepts in a structured way to hopefully facilitate a walk forward for you as a trader to start mapping out the market and building confidence with directional premise and not overcomplicating it. And here's the 100 level here on your fib extension, so we have a whole lot of confidence to expect some kind of intraday profit taking, and doing that again, getting down here in the midpoint of that consolidation. We'll just take the extension here. Inside of 1 day, day trade is at 88 pips right there. So almost 90 pips inside of 1 day. Okay, and that's 1 week for me. Think about that. I'm only looking for 50 to 75 pips on average. I know you probably can't believe it. Oh man, you got to be taking more than that. Well, I do take profits in a higher degree in terms of pips, but that's not my motivation. And that's hopefully what you are gleaning from all of my material, is that you don't necessarily have to be swinging for the fences, but be positioned to capture it should you get it. In other words, you're hitting singles to fill the bases. And eventually, if you hit that home run, not because you expected it, but when you have the bases loaded with all your singles, then it becomes a grand slam, and then you look like a wizard on the forums. You look like a Tiger Woods on the golf course in the Forex world. So all these things are repeatable for you as a trader. You can build your framework as a trader and experience level by just using the same approach, these same concepts, make them generic to you, that you inherently go to them over and over and over again. You're not looking to add any more fluff to them. You're not trying to tweak them. They're very essential core principles. Okay, same premise have here. Okay, we expected this low not to be, this level to be retested here. Okay, we have this high here. So market structure implies that if we are in a bullish scenario like we anticipate, okay, we're going to look for what? The low, and we start retracing from this high, we don't want it to come back down to that level. We don't want it to, okay? Well, what we'll be hunting is what? Here's your range from this low on the Friday. Let's grab that fib again. Here's your range. Okay, here's your 62% retracement level. Okay, price comes down, and your first entry, your entry to get long in here, this time of day is New York Open. Okay, and you can see a reflection in here, which I'm not going to draw. You can take this low to this high, it'll get the actual low in here, and your first profit is here. So intraday, just trading again with the higher time frame premise in mind, only looking to be a buyer simply because we have the highest odds of seeing a profit. Here's 50 pips intraday. Okay, again, that's a week for me. Okay, we have a higher low here. Okay, and look at the optimal trade entry in here. Okay, we broke this high here, and there's your retracement. Pull optimal trade entry from the low to this high. You'll get the actual the low here formed, and this is the London Open. What day of the week? Tuesday. Okay, we have the week's low on Monday. We have a confirmation, a continuation going higher on Tuesday. Again, looking for buys right on up. Now again, see this purple area? All this backdrop is that higher level mapping that we did. Okay, we've mapped out where the highest level of probability and directional premise is most likely to occur, and it keeps us focused on one direction. Okay, and something just occurred to me while I just said that. I have this set with purple. Okay, you may have this for your setup if you can tolerate the color. Maybe it could be green as a backdrop to that could be your subliminal indication that, hey, look, when I'm looking at the charts, I'm really focusing on buying because green being bullish. Or maybe you don't think green is bullish, but maybe you can attribute it to whatever color you want it to be, and maybe make it a red color or a red tint of some kind, or a pink or something like that, or whatever color you want to attribute to as a sell scenario. So that way you're always looking to chart with the bearish mentality. Okay, and again, there's no rocket science behind this. It's a very simple approach to doing it. You haven't complicated the matter. We stuck to just trading off of the higher time frame premise. Okay, and that's your directional premise. Okay, that's your directional premise. You don't trade every day. You don't anticipate trading every day. Okay, and you just wait for the setups that really line up with what you're looking to do as a trader. Okay, and when you get to the point where you can start trading very consistently, you'll start seeing the market through all of these time frames at one time. Okay, you'll start seeing it in a manner where you'll know you can move from one time frame or style of trading to another, and it won't be anything to you to do that. It won't take your um, mind away from what you need to be doing on the short term. If you're a higher time frame position trader, you could work within both directions of the marketplace, and there's nothing wrong with that. But there's a growing period that's going to be needed to get to that point, and as long as you are comfortable with that, you know it's not going to be hopefully disappointing to you as you grow and you have growing pain. So again, let's recap this and put this video to bed. When you're looking for directional premise, obviously you're looking at the monthly, weekly, and daily. That's your position trader's mindset. Okay, so every trade should have that in the forefront of your mind. In other words, where's the highest probability in terms of direction most likely to occur? You're going to find that by looking at that higher level monthly, weekly, and daily. Find the key support and resistance levels, determine the market structure, market profiling. All these things that we talked about in previous market teachings are applicable here. And obviously, a swing trader, you're using the daily, the 4 hour, and 1 hour. Again, looking for trades in the directional premise that's arrived at the position trader's mentality. Okay. The short-term trader, obviously using the 4 hour, 1 hour, and 15-minute time frame. Okay. That same approach to trading still will use those central tenets that you arrive at with the position trader and swing trader's mindset. Okay. Nothing's changing. There's no confusion. Okay, I've seen guys get frustrated and say, well, how can we trade if it's always, since something's always changing? What's changing, guys? The date's changing. Okay, new opportunities are presenting themselves, but nothing's changed in the higher time frame. Okay, you're still either going to be going up or you're still going to be going down on the higher time frame, predominantly one way or the other. Okay, it's going to be heavy weighted either to the bullish side or the bearish side, unless you're in a very, very tight, discernible consolidation. And we've already shown, and that's why I really highlighted this as an example, the cable where we were in this really tight consolidation down in here. This is still applicable. I mean, there's a lot of opportunity to be made in this little consolidation that may be viewed as consolidation small in some people's eyes, but there's a lot of opportunity to be making money in all of this before we even got all this rally up. This is cream. You want to be able to trade inside of this and still make money. Okay, and that's where you simply use the inside the range concepts, and it's done. You know exactly what you're doing. Okay, and there's no reason for you to be struggling trying to figure out what the directional premise should be. There's no reason for that. Okay, just look at the higher time frames, break your market down from the top down, okay, and stick to that. Only trade in that direction. Guess what that's going to mean? You're going to probably miss some trades. And guess what? There's absolutely nothing wrong with that. I miss a million trades, and some of them are absolutely barn burners. And I would have seen them coming, and many times I could have probably easily done the counter trend trade, but I don't care because I want to have a life. I'm comfortable with the amount of money I make, and I'm very complacent with the approach that I've adopted as a trader. I've done all this stuff that you want to be doing right now, scalping 15 times a day and 40 times a week and 300 by the end of the month. That's great. If you want to be that type of trader, go right ahead, and I wish you profits. But I think over time, if you can sustain yourself, you're going to find that it's a lot more lucrative, okay, to be passive in trading. You don't have to be in here all the time. In fact, my stress level is next to nothing because I don't spend that much time in there. Okay, I actually stress more about doing these videos for you guys than I do trading. And that's really what it gets to. Are you doing this to make money and have a better life, or are you doing this to compete? And if you're in here to compete, you're doing it for the wrong reasons. Okay, number one, it's to make money, and you want to be making money and having a very nice life, and you can do that while you're building your equity. Okay, and when you have a whole lot more money at work and you're taking these types of trades, it's unbelievable how much money can come into your account just on a weekly basis, let alone for the year. So again, hopefully this has been insightful to you guys, and it's been one more step further for you to be developing a directional premise. And again, we didn't apply every tool. I just stuck to the core principles, keeping your focus on what's essential. Okay, we talked about core essentials with the market structure. We talked about core essentials with directional premise from the higher time frame direction or premise from a top-down perspective. And that's it. That's all you need. Now, when you have that premise in mind, you can apply all these other tools that are applicable based on the specific criteria for that given day or week or month, whatever type of time frame you're looking at based on your style of trading. Okay? So with that, guys, I wish you good luck and good trading.